Welcome to the latest Wealthwoke video. As part of our journey, we're looking to find out more about some of the best investment opportunities out there so that you can make informed decisions on where to invest your hard-earned money. So, when I heard about the unique philosophy behind the Gryphon Asset Management multi-asset range of funds, I knew I had to check it out. Earlier this week, I sat down with their Chief Investment Officer, Reuben, Beelders, and we did a deep dive into these funds. They have a high conviction in what they're doing, so you're either going to really agree with them or you're not. Watch the video and you make your mind up for yourself. Reuben, thanks for joining us today, first of all. It's really good to be sitting with you. Okay, tell us a little bit about the funds in this multi-asset range.
Our business philosophy is one of indexation. So we have a range of funds, and indexation addresses the various asset classes that investors are exposed to. So we have cash funds, we have equity funds, represented by the All-Share Tracker Fund and also a Gryphon Global Equity Fund. We don't have bond funds at the moment, but we could launch products like that should there be a demand from investors. We then take those underlying building blocks of the asset classes which are indexed, so cash and equities, and using those building blocks we then construct our multi-asset funds. We have two multi-asset funds. We have the Prudential Fund, which is a Regulation 28 compliant product, so it has a maximum of 75% in equities, and then we have the Flexible Fund, which is not Regulation 28 compliant and can have 100% in equities. Now, the philosophy behind those two products is that we want to be exposed to the asset classes which generate inflation-beating returns. And really, when the times in the market are appropriate, we want to be fully exposed to those asset classes. And when not appropriate, we don't want any exposure to those asset classes. So that's slightly different to the approach that the market has taken. If you look at most multi-asset funds in the market, you will see that the asset allocation exposure to equities, to bonds and to cash remains roughly within a range over a period of time.
Absolutely. I mean, that is unbelievable to me. Not unbelievable, but you're all in or you're all out.
Correct. And once again, it's based on academic research, which says that while very little value can be added in terms of asset stock picking, a lot of value can be added when it comes to asset allocation. So if one looks at investment returns over time in a balanced portfolio, the bulk of returns comes from asset allocation. So what we've done is we've said, right, we will index our underlying asset classes, and then we will build the skill to make sure that we asset allocate and thereby achieve as much of the returns possible for our investors.
Is it possible to be Regulation 28 compliant and be all in on equities though?
Okay, as I indicated, so that's the distinction between the two funds. The Prudential Fund, you are only limited to 75%.
Oh, so there you 70. If you're all in, you're basically 75%
correct,
equities.
Correct.
Okay, got it.
So correct.
Now, doesn't that actually introduce more risk? Because if you're wrong, you're very wrong, and if you're right, you're very right.
Well, our philosophy takes that into account, and the proprietary models that we have developed take that into account. So let's look at the past 8-9 months in financial markets. We exited equities at the end of August 2018, and for the first 3 or 4 months that decision proved to be very prescient in that we outperformed our competitors handsomely. Over the past 3 months, subsequent to the Fed pivot, it appears that equity markets have run very hard. Our long-term performance is still very good, but over the short term, we've obviously underperformed those of our peers that have exposure to equities. However, that's always been our logic. We're never trying to fine time the exit or the entry into the market. There will always be possibly a short period where we are contrary to the market or what the market is doing. But we're quite comfortable with that because we think the risk inherent in getting those returns towards the end of the market's performance are just too risky, and so we're quite prepared to step back and avoid that.
All right, and I assume where we are now is we're still all out.
We are still only exposed to cash, so we have no exposure to
So you think there's a pullback coming?
That is certainly what our models are indicating. What one must realize is that if you are exposed to cash, you're getting a return of between 6 and 7% per annum. And one must never forget that relative to equities have to exceed that. So while equities have exceeded that over the past 3 months, if one looks at a longer term period, in fact, over the past 5 years, equities haven't given you much more than the dividend return in the market, which is 3 to 4%.
True.
So
never really think about it like that, right?
Correct. So one must bear in mind that the asset classes other than cash must beat cash.
Yeah.
Cash at the end of the day is your default asset class, and that's where you want to be because there's very little risk in cash. And if I may say so, I think that's something which investors must bear in mind. It's about risk-adjusted return. So it doesn't help someone saying to you, I've got a better return than cash, but I took more risk than cash. Because on a risk-adjusted basis, cash would still be the better alternative.
Now, what about the whole FOMO thing? So don't you get pressure from investors at times when you're out of the market and the market's performing?
Sure, I think there is that risk, but at the end of the day, what we want to do is provide the best return for investors. Our long-term analysis of the market indicates that our approach does in fact do that. And there will always be times where investors believe that we should be exposed to equities when we are out of the market. But I think the long term does indicate that our proprietary models work quite well. The same pressure happens to us in terms of the indexation of our underlying asset classes. So investors will often say to us, but as an index product, you are overexposed to stock A or you're underexposed to stock B. As Cassie indicated, over time, indexation still outperforms 70 to 80% of active managers. So we've learned to deal with that pressure.
For sure. Now, tell me a little bit about what are the factors that sort of determine whether you're in the equity markets or you're out? What do you look at?
So the South African market, we believe, is a commodity-driven market. While commodities as a percentage of our GDP have declined over time, foreign investors still associate South Africa with commodity performance. Commodity prices are a key input into our proprietary models. Another key input is the earnings of the companies in the all-share index. So we don't believe, for example, that the index should be going up if earnings are going down. In fact, that's to us a very worrying sign. Earnings at the end of the day are the foundation upon which the price-earnings ratio is calculated. So when we see earnings declining, we certainly believe it's time to reduce exposure to equities. So in addition to commodity prices, earnings, we obviously consider factors like currencies. The South African currency, for example, is highly correlated to most international commodities. So is the Australian Aussie dollar, so is the Canadian loonie. And we watch a number of currencies in order to get an indication of whether this is just a South African phenomenon or it is in fact a global phenomenon.
So would you say it's a proper quantitative model, or is it more a gut feel based on the factors?
No, it's quantitative. When the lights go on, we
and
make
that's
a
little
decision.
green or red lights in
Correct.
your offices.
So, yeah, it's not. Our view is that what you want to avoid in financial markets is emotion. Emotion costs you money at the end of the day.
Oh, yes.
So when it comes to making forecasts, we often find that people have an emotional bias. They would like the economy to be stronger than it is. But at the end of the day, the reality is often different. So our proprietary models are simply a reflection of commodity prices, currencies, earnings as they are today. We make no projection whatsoever regarding the future, and we make our decisions on that basis.
And how has this philosophy actually translated practically in terms of returns over the last few years?
Well, the philosophy is certainly done as we spec the product. From the perspective of returns, we've generated the returns that we believe are acceptable based on the underlying asset class performance. The performance, I believe, however, distinguishes itself on another level in that because 99% of our peers maintain their asset allocation quite constantly over time. The fund has distinguished itself in that it has provided a very different range of performance. So you will find, for example, that up until the end of December, the fund was top or close to the top over a range of periods, 12 months, 24, 36, 48 months. The fund is now recently 5 years old. However, there will also be times, like the last 6 months, where the fund underperforms the market. The longer term performance, though, however, is still very, very good. So what we do find is that investors have the assurance of, could I put it, drawdown protection. So if there's a drawdown in the market, investors at least know that my fund capital is secure. And that really is our objective.
Don't lose money.
Correct. So, you know, as I think it was Warren Buffett said, the first rule in investing is don't lose money. The second rule in investing is don't forget the first rule. And that certainly is part of our philosophy.
Okay. Now, I'm assuming that because you don't sort of actively engage in stock picking, etc., your fee structure is slightly lower than your average equity fund manager.
Absolutely. So our philosophy at Gryphon is that fees are very important when it comes to long-term returns. So performance is ephemeral, you know, performance comes, performance goes, but fees are constant. So all our products are offered at very, very low fees. That's part of our philosophy. The critical thing is about the multi-asset funds is because we are relying on underlying index products, we take the very low cost structure of those products into the multi-asset funds. And so the multi-asset funds are, in terms of the Prudential, I think in the top 5 cheapest products on that equity, on that unit trust sector.
So give me an idea of the range of what we're talking about as a percentage of the fee.
I think our base fee on those products is 35 basis points for the Prudential and the flexible fund. Obviously the TIC, the total investment cost, is higher, but we believe that as the fund grows, the TIC will migrate to the 35 basis points.
I mean, that's great. That's
so that is very low. And if I can just add another very important point, very often fund managers put a performance profile together when their funds are small. So let's say their funds are 100 million, they are able to invest in a small company which offers a unique return. But once those funds grow and they've got $1 billion under management, they are unable to replicate that performance. With the multi-asset products, because you are relying on your indexation building blocks, we'll be able to replicate that performance whether we are at 100 million, $1 billion or $2 billion.
Yeah.
And that's really a critical factor to us. So we don't want to put a performance profile, a track record together which we can't replicate when we're bigger, and we really believe that we'll be able to do so over time.
I guess, when I look at why I would invest in this range of funds versus an ETF, first of all, I guess one of the funds are Regulation 28 compliant, so that's really good. But the big thing is, what worries me sometimes in the ETFs is the asset allocation, and that I'm pretty much always 100% exposed to the markets, and that makes me a bit nervous sometimes when I think the markets have peaked. Whereas what you're saying is, even though you follow the sort of index tracking, you can pull in and out of the markets when you think. So if I believe that you guys know when to do that most of the time, that's why I'd invest with you rather than with an ETF, right?
Sure. I would, however, emphasize that our focus is long term. So we believe there are 2 types of asset allocation, strategic and tactical. Tactical focuses on trying to call the small trends in the market. So when the market is going to go up 15% and down 15%, a number of investors think they can get that right. We don't believe that it's something you can do correct sustainably. What we really are interested in is strategic asset allocation. So in 2008, before the market fell almost 50%, we wanted to be out of the market. The market was down, I think, from August to December, 16-17%, we were out of the market. And what we are trying to say to investors is, don't try and call the small moves in the market. The chances are you may get out in time, but you may not get back in time. We will ride that out. But when it comes to the larger moves, those are the ones we're interested in, because at the end of the day, those are the ones which really cause damage to your wealth.
Reuben Beelders, Chief Investment Officer at Gryphon Asset Management, thank you so much for your time. That really, really opened my eyes, and I applaud you for certainly your conviction in your investment philosophy.
Thank you. Pleasure.